Now let's look at the profit model of a credit product. Let's use a credit card as example. This is something everyone is very familiar with. In order to get profit, first let's look at revenue. Then we'll look at expense. Okay. Every credit product earns revenue based on the interest rate. So at the very top, you have the interest revenue. The only difference is that credit card charge more, like 16, 17%. Other products probably charge lower, right? Like mortgage is only 5%. Besides interest revenue, there's also non-interest revenue. For credit card, one important fee is the interchange fee. When you swipe the plastic at the retail merchants, the merchant will pay interchange fee to the card association. Then part of that is transferred to the card issuer. So that's an important source of revenue, even though the card holder might not pay any interest revenue, they just pay it off every month. But the card issuer can still earn quite a bit from the interchange fee. Another important fee is the annual fee of a credit card account. This usually applies to the premium products, right? So you earn additional benefits such as you can use the lounge at the airport. You have a richer rewards tier, but you pay an annual fee of let's say $100 or even $400 for the high-end credit card product. Okay, so then there are other fees. For example, late fee if you are late with the payment, over limit fee. If you go over your limit, for convenience, the card issuer approve your transaction, but they charge a fee. Some they do, some they don't. These are just some examples of different fees. That's another important source for revenue as non-interest revenue. For expense, the first item is the cost of fund. Depending on the source of the fund, for full service banks, they have the checking savings account. As you know, the checking account in the US and Canada, they pay very little, right? So that cost fund is very low. So some banks or some lenders, they have to rely on the ABS or borrow it through commercial paper. So that cost is naturally goes up in the market. That depends on the credit ratings of that issuer. So cost fund, one expense item. Next one is operational cost. This is a bigger item. This includes all the people working for the credit card business. In this case, then there's a call center, right? So all the system, all the telephone, computer systems, supporting the operations, the credit card hosting system, right? Produces the statement, letters, all of those, they are part of the operational cost. Then we have the last but not least, the credit loss. So this is an important factor. As you will see quickly, it's actually a good portion of the overall expense, and we need to manage it very carefully. Okay, so when you have the revenue from interest and non-interest sources, you deduct the cost of fund, operational cost, as well as the credit loss, you get the profit for the credit card business. So for other lending products, the profit model is very similar. The only difference is that you might not have a lot of the fees revenue, right? So if you are, especially if you are close-end installment loans like mortgage, personal loans, usually you don't have this interchange fee, annual fee stuff. Okay, but all the other stuff, cost of fund, operational cost, credit loss, they still apply, just at different levels. Okay, so here's the profit model of credit card.